Hello and welcome to another episode of Darwin Investors. All right, if you're not confused by this market, then you're just not paying attention. And maybe that's a good thing. Just buy good companies and not worry about it. Just go Warren Buffett style. But in my case, I'm going to try and clear up some of the confusion in this market, at least the way that I see it. And the way I'm going to do it is, first of all, I'm going to show a couple of videos from last week's FOMC meeting and then discuss the questions that were asked and Jerome Powell's answers and discuss why these answers sent the market upward. Then after that, we're going to have a look at a little video clip from Mike Wilson over at Morgan Stanley. He's known as like the biggest bear on Wall Street. And we're going to get his thoughts on the market and where I agree or disagree with these thoughts. And then finally, we'll have a look at my own portfolio because I accidentally got roped into the wheel strategy, which is a strategy that I don't like to employ, but I'm kind of stuck in it right now. And we'll look at what I did to get into it and how I'm going to try to get out of it. So we have a lot to unpack, so let's go ahead and get into this. So you might have noticed that the stock market ripped higher during this past week's FOMC meeting. Initially, the Dow Jones was down like 500 points when he was giving his prepared remarks. But then as the question and answer section began, the market started to rip higher. So let's go ahead and look at the first question that was asked, Jerome Powell's response, and why this might have sent the market higher.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from the Washington Post. Over the last quarter, we've seen a deceleration in prices, in wages, and a fall in consumer spending, all while the unemployment rate has been able to stay at a historic low. Does this at all change your view of how much the unemployment rate would need to go up, if at all, to see inflation come down to the levels you're looking for?
So I would say it is a good thing that the disinflation that we have seen so far has not come at the expense of a weaker labor market. But I would also say that disinflationary process that you now see underway is really at an early stage. What you see is really in the goods sector, you see inflation now coming down because supply chains have been fixed. Demand is shifting back to services, and shortages have been abated. So you see that in the housing services sector. We expect inflation to continue moving up for a while, but then to come down, assuming that new leases continue to be lower. So in those two sectors, you've got a good story. The issue is that we have a large sector called non-housing service, core non-housing services, where we don't see disinflation yet. But I would say that so far, what we see is progress, but without any weakening in labor market conditions.
Has
Go ahead.
Has your expectation for where the unemployment rate might go changed since December?
You know, we're going to write down new forecasts at the March meeting, and we'll see at that time. I will say that it is gratifying to see the disinflationary process now getting underway, and we continue to get strong labor market data. But you know, we'll update those forecasts in March.
So someone finally got Chair Powell to admit that the rate of inflation is coming down. He even used the word disinflation 3 different times in that clip. Disinflation being different from deflation. Deflation is a drop in the price of goods, such as what we're experiencing, say, in used cars, consumer electronics, and apparel, or what have you. Disinflation is the rate of inflation is coming down. And for the first time, he's acknowledging that. The first time it looks like the Fed maybe has a little bit of a clue, because they're finally saying what we all already know. Old Chair Powell would have just said, oh, well, inflation is still way too high and the economy is way too strong right now, so we're going to have to keep on hiking up rates and just leave them there for longer. And he's just going to ignore all of this weak economic data that we see coming at us every single day. They're going to pretend that they're just living in another world, a different economy, and they say, oh, well, we got to keep up our credibility. Well, looking clueless doesn't up your credibility. Showing competence ups your credibility, and it shows that maybe with a little bit of competent leadership, we can engineer a soft landing and put this economy back on track. And that's why the stock market went up. It's because they were showing some like competent leadership, at least in my eyes, by acknowledging that One, that the housing sector is actually going to be weakening, or like in the CPI data, that number is going to be coming down. It's going to show that inflation is going to come down. But he also said something else. He said that they don't necessarily have to wreck the unemployment rate just to bring down the cost of wages. If wages come down, we can actually leave the unemployment rate low like it is and still continue on and engineer a soft landing with full unemployment. That is the Goldilocks scenario. So let's see if that's actually happening, because we got our jobs data out yesterday. So the JOLTS report came out yesterday showing that we had an increase of 517,000 jobs. And initially that was taken pretty negative because we were only expecting 189,000 jobs. What's with these 517,000 jobs? That's only going to force Fed Chair Powell to crank up the rates even higher and just leave them there now that our unemployment rate is a 53-year low. Well, not necessarily, because remember, he said the point of the Fed now is not to drive the unemployment rate up, that what they're trying to do is drive down the core services PCE minus housing, which basically just means they're trying to bring down wage inflation. And so when we look at this, even though we added 517,000 jobs this past month, the wage inflation is actually ticking down. As a matter of fact, 4.4% is the lowest since August of 2021. So things are tailing down right now. And this is what the Fed wants to see. They don't want to see the economy rocked with high unemployment. What they want to see is the services sector, the core services PCE rate of inflation come down. That's what they're looking for. Now let's look at the second question that was asked that sent the market soaring. You might have heard some announcers refer to it as the penultimate question of the day. Penultimate meaning just the second to last question. Let's have a look at this clip and see why this might have sent the markets up.
Thank you, Chair Powell. Greg Robb from Market Watch. In the minutes of the December meeting, there was a couple sentences that struck people as important. When the committee said participants talked about this unwarranted easing of financial conditions was a risk, and it would make your life harder to bring inflation down. I haven't heard you talk much about that today or in the statement, so I was wondering, has that concern eased among members, or is that still something you're concerned about? Thank you.
I would put it this way. It's something that we monitor carefully. Financial conditions didn't really change much from the December meeting to now. They mostly went sideways or up and down, but came out in roughly the same place. It's important that the markets do reflect the tightening that we're putting in place. As we've discussed a couple times here, there's a difference in perspective by some market measures on how fast inflation will come down. We're just going to have to see. I'm not going to try to persuade people to have a different forecast, but our forecast is that it will take some time and some patience, and that we'll need to keep rates higher for longer. But we'll see.
But we'll see. In those three words, Chair Powell just acknowledged that the Fed was truly going to be data dependent. They went from being unconditionally hawkish to conditionally hawkish. And we all know what those conditions are. The PMI data just came out last week for the month of January 2023 with a number of 46.9. Anything less than 50 is a decline in manufacturing, and by extension, a decrease in consumer spending. We also got the data of earnings EPS estimates for the coming year. And what we're showing is that for Q1, it's earnings estimates in the S&P is supposed to be down 1.8%. Q2 is down 2.3%, but then it's supposed to rebound in the second half of the year, and quarter four is expected to be incredibly strong with 9.4%. All this spells out to me is a recession is on the way, and maybe the Fed ought not to be cranking up interest rates during a recession, because that's not good for anyone. They also, the market also has the Fed funds outlook looking, peaking out at 4.91 and then having 125 basis point rate decrease by the end of the year. This is not what the Fed is saying, but if they're actually going to be data dependent, this is what the market has priced in, and this is where the market believes the Fed is going to be going. And if they're truly going to be data dependent, they're going to be looking at our manufacturing data, at the layoffs that have been happening across all sectors, not just tech. I mean, Dow Chemical just laid off, Goldman Sachs, Starbucks, it isn't just tech laying off, McDonald's, everybody's laying people off right now. If they're truly going to be data dependent, then they're going to start looking at that sort of thing. And then maybe this cut might be in the cards for us. Now, I've done nothing but give quite a bit of bull sentiment during this here video, so let's go ahead and hear a little bit of bearish sentiment coming from Mike Wilson over at Morgan Stanley. We can always count on that guy to give us some bearish sentiment. Let's have a look at this clip, and then we'll break this down.
Is there nothing about the way this market has responded to those earnings, which, as you say, have been absolutely terrible? Is there nothing about how this market has responded to them that offers you maybe a bit of a challenge to this bearish view?
Well, absolutely. I mean, no one respects the market price more than I do, John. You know that. If you don't, you're destined to lose money. But I would suggest that remind listeners that that's what happened the last 2 quarters, right? We had stocks sell off into the quarter, and then the numbers were bad, and then the stocks rallied on that. So, and then of course we made new lows. So I don't think you can conclude anything if you don't have evidence that you think this is actually the trough rate of change. And we don't have that evidence. And in fact, we have analysis that would suggest that the trough rate of change is not here yet, that we have several more quarters of this, further disappointment, and we think that that disappointment could actually accelerate in the first quarter of this year.
Let's pick up on that. We've had earnings from the banks. Tech's still coming in. Can you talk to me about where you think reality might bite on the calendar? You mentioned a period there, Mike. Where do you think reality does bite?
Well, look, for us, as you know, John, it all comes down to profitability. We think that the pandemic and the recession and recovery that ensued led to this incredible incremental positive operating leverage environment driven by higher inflation. And now inflation is coming down faster than costs are coming down. And that mismatch is leading to significant negative operating leverage. We think investors, at least investors we talk to, and we talk to probably more investors than anybody in the world, we think that feature is either underappreciated or misunderstood. We also think that feature is misunderstood by companies, because not only have investors never seen this kind of an environment, but most CEOs have not seen this environment unless they've been a CEO for 30 or 40 years, which that's not many of them. And so I just think that this is a unique period in history. I think people are going to be surprised on the downside here on the profitability, just like they were surprised on the upside. Okay, let's go back 2 years ago when we were the raging bulls on earnings, saying that operating leverage was going to surprise on the upside. Nobody saw it. I mean, in fact, it exceeded our expectations too. But we saw this incredible positive revision story because companies kept underestimating that positive operating leverage. And we think it's the exact opposite now. And it's just going to be a drip, drip, drip until they finally capitulate and say, you know what, we don't know what's going on. Let's just slash the numbers and let's make this our final cut. And we're not there yet.
Now, I never want to say that I know more about the stock market than Mike Wilson does, and certainly I don't, but I just feel like he's been so bearish for so long that he has a little bit of difficulty seeing the bullish side of any argument. And so we'll talk about his declining profit margins a little bit later on, but right now we'll go ahead and focus on corporate revenues and how he's talking about how that earnings have been so disappointing, and certainly they have been in certain companies, but by and large they've been pretty normal. The historic average for beats have been 62%. This year it's been 65%. The average beat has been lower than normal, and you might say it's because even that they're beating only 65%, though they're guiding really low, but it's pretty normal to guide pretty low every single quarter, albeit they are guiding lower this quarter than what is normal. So let's go ahead and look and see how the stock market has actually been performing this year. So the S&P 500 this year is up 8%, the NASDAQ's up 15%, and the Dow's up 2%. Now we would expect that things are actually going to tail back a little bit, where we wouldn't expect the S&P to be up 96% this year, the NASDAQ to be up 170%. Maybe the Dow would be up 25%, but the thing that we're going to focus on right here is what Mike Wilson was talking about, was about the profit margin decline that we're about to experience this year. But when we talk about that, we're not really talking about every single sector of the economy. we're talking about mainly what I believe we're talking about is the consumer staples. And as a result of that, the consumer staples sector of this economy has not been performing as well as the S&P 500. You can see the consumer staples are down 1.1%, though the S&P is up 8%. And what's happening here, I believe, is that inflation is going down. And so a lot of companies can't charge as much as they would like for their products going forward to maintain their margins. Now, the company can cut back on their advertising, and many have, but when you've done that, the other thing that you have to cut back on is your employment. Now, at best, you can actually just stop hiring, but at worst, you're going to have to cut your people altogether, and that's going to crank up the unemployment rate. And the market's actually planning for that already when we see that the staple sector is down while the S&P 500 is up. And the staples isn't the only sector that's down. It's the one I think this applies the most to, but the utility sector is down, the healthcare sector is down. Basically what's happening is last year's winners are this year's losers so far, but the year's only a month old, so I wouldn't put a lot of stock in this. But however, I would say that the profit margin thing that Mike Wilson was alluding to does apply to this consumer staples sector. Now, when we look at sectors that are actually up for this year, it's going to be the consumer discretionary sector, but also we'll see that the tech sector is up this year. And the tech sector is up 15% this year, I guess the same as the NASDAQ. It makes sense. So what's happened here? Well, when you look at the tech sector overall, what you're going to see is that you've got a string of disappointing earnings out there, and you got to wonder why the tech sector is moving really high despite that. Well, that's because what I believe is happening to tech is they're kind of still working their way through some unbeatable comps due to the stimulus money. And so the market understands that they're not going to generate the kind of profit margins that they did back in 2020 and 2021. That was just kind of like a stimulus-driven one-off, if you will. And the same thing seems to kind of be happening to the energy market right now due to events in Ukraine. They profited immensely last year. And even though a lot of these energy companies are posting great profits right now and even announcing huge buybacks, their stocks are going straight down. And because their stocks are going straight down, and I knew they were going to report fantastic numbers, I was going ahead and selling puts on a lot of these energy companies. Well, what's happened is now I'm accidentally playing the wheel strategy on a lot of energy companies when I don't mind owning them, and that's the whole point of the wheel. If you're going to sell puts, it should be something you don't mind owning, but you don't necessarily, at least me, I don't necessarily want to own. When I play, I don't like the wheel. And the reason why I don't like the wheel is because you're selling puts and the only time you get a sign is when something collapses. And the only time when you sell a call is when it rockets higher. And so you're not getting any of that like upside, and you're getting all of the downside. And so the wheel is not a strategy that I generally like to play, because you're not getting anything when something rips higher, and you're only buying something when it's falling through the floor. But nevertheless, now I own a whole lot of energy stocks. So let's look at the numbers of these energy stocks that I'm now holding as a result of their earnings. Well, one of the stocks I'm holding right now is going to be Marathon Petroleum. And Marathon Petroleum earnings topped on margin gains, and their buyback was raised. It was just a lights out quarter for them. And they reported earnings on Wednesday. And for their troubles, all that's happened is they've gone down 10.5%. Chevron is another one that I own, and they recorded record profits and a $75 billion buyback. And if you look at them over the last 5 days, all they've gone down is 5%. So these are the companies that I'm holding on to. Another one that I'm actually holding on to right now is Conoco. Conoco also, just like the rest of them, posted lights out earnings and revenue. Now, the revenue might not have been what the street was looking for, but nevertheless, it was still really good because the expectations were very high. And for all of that, the ConocoPhillips is down 11%. And so what's happening with these energy companies is exactly what happened with the tech companies a year ago, because those companies back a year ago were also producing some really nice earnings. And so for that reason, I had a whole lot of tech companies that are like, wow, these earnings are great. I'll just go ahead and sell calls against this and wheel this thing. And now the same thing is happening to me for energy. So I know I drive a Tesla and I can't even think of the last time I went to a gas station and bought gasoline, but I would sure appreciate it if you all would, because now I have Phillips 66 and I have Conoco and Chevron and Marathon, and that might be it. But that is speaking of that'll be it. That'll be it for this week. So if you got anything else, guys, please like, subscribe, hit that little notification bell. Until then, we'll see you next time. Have a great day. Bye. And now a word from my sponsor. Guys, do you have a favorite commercial? Man, I do. And when I'm watching my very favorite commercial, I really do like to have something in my hand. And it's this week's sponsor, which is beer. And I know what you were thinking, but guys, I'm a family channel. And this week's sponsor is Lagunitas IPA. And this IPA unapologetically gets 5 Kate Rooney's out of 5. Have a great day, everybody. See you next week.